We've all been there. The end of the month rolls around and it's time to pay the rent. You open your wallet and it feels like you're watching all your hard-earned cash vanish into thin air. Rent can often feel like a relentless financial toll, a constant drain on your income. But what if there was a way to never worry about that deadline anymore? A quick solution might be ETFs. But with an ever-growing list of similar-sounding ETFs to choose from, finding the best is an increasingly difficult task. So how can investors change the game to shift the odds in their favor? The answer is investing in sector ETFs. In this video, we will reveal the top 6 sector ETFs with some of the market's highest dividend yields. We'll show you how much you need to invest to make rent payments of $1,700 per month from dividends. In fact, we'll show you a sector ETF that needs less than $40,000 to pay rent for the rest of your life. In the end, we'll demonstrate how to make a portfolio of these ETFs to make your investment more stable and hit the $1,700 per month mark consistently. But of course, before investing in sector ETFs, you should know what they are, how they work, and why they're better. A sector ETF is like a basket of stocks from a specific industry, such as technology or energy. For example, let's say you want to invest in the tech industry, but you don't know which specific tech companies to pick. Instead of buying individual stocks, you can buy this basket, which already contains a bunch of well-performing tech company stocks. It's easy to buy and sell, just like regular stocks. These ETFs are good for both investors and speculators. They usually follow an index and don't have big tracking errors. Some even try to double the index's returns. Sector ETFs are cheaper than mutual funds and give you diversification. It's a simple way to invest in a whole industry without picking individual companies. Okay, so now that you know what sector ETFs are, let's move on to our top 6 picks of the year. Each of these picks requires a smaller initial investment compared to the one before it, and all will reach that nice monthly income goal of $1,700. Starting at number 6, we have Invesco KBWD High Dividend Yield Financial ETF. Known by the ticker symbol KBWD, this ETF is one of the most consistent and stable ETFs when it comes to dividends. In fact, over the last decade, it has paid on average close to 15% annual dividends each year. Currently, though lower than average, it has a pretty strong 10.75% dividend yield, which is still higher than what you'd typically get from other similar investments. So how much would John need to invest to never worry about making rent? Based on a 10.75% dividend, if John wants to earn $1,700 every month, he needs to invest $189,767 in this ETF, which would end up paying an annual dividend of $20,400 or $1,700 per month. So how does this ETF stay this consistent? This ETF mainly invests in financial companies like banks and other financial institutions. But it doesn't just pick any financial companies. It goes for the ones that offer the highest dividends. That's why it's called a high dividend yield ETF. It's like trying to get the juiciest fruits from the tree. KBWD spreads its investments across 40 different companies with a stronger emphasis on its top 10 holdings, which play a significant role. These holdings deal with loans to small businesses, mortgage investments, and traditional banking services. Another reason some people might like KBWD is that it's currently priced lower than it was a few months ago. While most other investments have gone up in price, this one has gone down a bit. This could be seen as a chance to buy it at a discount. Also, when investments are cheaper, the dividend yield tends to go higher, which is a bonus for income-focused investors. Next, we have Virtus Private Credit Strategy ETF. Known by the ticker symbol VPC, this ETF invests in the booming financial sector with a current dividend yield of 13.39%. This means if John aims to receive a monthly income of $1,700 from this ETF, he would need to invest $152,353. This investment would generate an annual dividend of $20,400, translating to his desired $1,700 per month income. This ETF focuses on a different way to generate income, especially when traditional bonds are not doing so well due to rising interest rates. So what does VPC invest in? It tracks something called the IND-XX Private Credit Index, which includes assets related to private credit. These assets are not the usual stocks and bonds you hear about. Instead, they involve things like business development companies, BDCs, and closed-end funds. These are companies that provide loans and financing to other businesses, especially ones that traditional banks might ignore. This is a good strategy because these BDCs are finding opportunities to make money, especially with the help of low-cost debt and refinancing. VPC is more appealing because it's also invested in floating rate notes, FRNs, which are bonds that aren't that sensitive to interest rate changes. So even though BDCs are considered high-yield assets, which can be risky when interest rates go up, they are actually performing well compared to regular stocks this year, a win-win situation for the ETF. At number 4, we have Capital Link Global FinTech Leaders ETF. Known by the ticker symbol COIN, this ETF has a current dividend yield of 17.69%. This means that to make $1,700 a month, in this case, John needs to invest $115,319 into this ETF. By doing that, he would get an annual dividend of $20,400, which works out to exactly $1,700 each month. The reason this ETF is hot in the investing market is because it focuses on a specific area of the technology industry called fintech, which stands for financial technology. Now, what is fintech? Well, it's all about companies that use technology to improve things in the finance world. This could mean making online banking smoother, improving risk management for banks, or even creating software like TurboTax and QuickBooks that we use for managing our finances. What's interesting about COIN is that it doesn't just invest in typical fintech companies. It also includes big names like Amazon, Oracle, and Microsoft, even though they're not finance companies. They play a role in fintech by providing the technology and tools for financial systems to work. COIN is a bit different from other funds because it divides its investments into 2 buckets. One is for companies that use fintech to improve their existing businesses, and the other is for tech companies that help set up fintech systems. So it's a mix of different players in the fintech world. One thing to keep in mind is that these higher dividend yields are usually not stable for the long term, and consistent income could be a problem. In the end, we'll show you how John solves this problem. At number 3, we have ProShares Global Listed Private Equity ETF. Known by the ticker symbol PEX, this ETF is another top pick from the financial sector, offering a really high dividend yield of about 19.72%. This means to receive a monthly income of $1,700 from the ETF, John will need to invest approximately $103,448. After that, this ETF will generate an annual dividend of $20,400, which equals $1,700 per month. Now, let's break down what this ETF is all about. PEX mainly invests in something called private equity and BDCs. These are not your everyday investments, they're unique. These companies are involved in private equity, which means they make investments in other companies to help them grow. Some of the companies in PEX's list might surprise you, like Amazon, Oracle, and Microsoft, which aren't finance companies, but they play a role in this world by providing the tech and tools needed for financial systems. Having them in your investment mix is actually a good thing. It adds diversity to your portfolio, which means it helps spread out the risk, making it less likely that you'll lose a lot of money all at once. This ultimately helps reduce risk and add some income to your pocket. Now, moving on to the high dividend leagues. At number 2, we have Sonic Shares Global Shipping ETF. Known by the ticker symbol BOAT, this ETF is an investment fund that focuses on the international maritime shipping industry, providing investors with exposure to companies involved in sea transportation. As of the current year, this ETF has offered its shareholders an impressive dividend yield of 34.58%, which is very lucrative when you want higher returns from less investment. For John to earn a monthly income of $1,700, he would only need to invest $58,994 in this ETF, making it our first ETF to need less than $100,000 and almost half the investment of our previous ETF. This ETF presents an opportunity for investors to tap into the significant role that global trade plays in the economy and potentially benefit from the growth of the shipping sector. The ETF holds a diversified portfolio of 50 different investments, and its holdings are divided into various subsectors, with most holdings in container deep sea and offshore shipping, followed by dry bulk deep sea, along with offshore shipping and crude oil transportation. The top 10 companies comprise more than half of the fund's portfolio and includes companies primarily from the United States, Europe, Japan, and Hong Kong. The ETF presents a bullish investment opportunity due to its reliance on global trade, just-in-time manufacturing, and inventory management. But like all high dividend yield ETFs, maintaining that 34.58% on a yearly basis can be hard. In the end, we will show you how you can profit from this high yield with the stability of KBWD's ETF. Next, and our last sector ETF with the highest dividend yield, is Crane Shares China Internet and Covered Call Strategy ETF. Known by the ticker symbol CLIP, this covered call ETF has quickly caught the attention of dividend investors. How much, you say? Well, though quite new to the market, this ETF has recently shared a current dividend yield of 58.46%. Before showing how much John needs to invest to make his rent income, first, how has this ETF been able to share that high dividend yield? CLIP uses a smart strategy called covered calls. It involves making money by holding on to certain investments while also making more money by selling options. It's like having your cake and eating it too. This ETF is focused on the exciting world of Chinese internet companies known for being a bit wild in the stock market, and that is where CLIP comes in. It takes advantage of this excitement to potentially give you more profit compared to tech investments in the US or other parts of the world. Okay, so let's talk numbers. Based on the current dividend yield of 58.46%, John would only need to invest $34,896 into this ETF to make an annual dividend of $20,400 or $1,700 per month. But high yield always comes with some risks, and CLIP is no different. It can be a bit bumpy, just like any roller coaster. So what do you do in this case? The answer is diversification, which can be achieved by making a portfolio of all the sector ETFs. For example, we know KBWD has a stable dividend yield of 10.75%, VPC with a decent 13.39%, Coin has 17.69%, PEX with 19.72%, BOAT with 34.58%, and CLIP with the highest dividend yield of 58.46%. If we add all these together and divide it by 6, we get our portfolio dividend yield of 25.76%. Based on this, for John to reach his monthly income goal of $1,700 per month, he needs to invest $79,193 in this portfolio, which will give him an annual dividend of $20,400 or $1,700 per month. And this income from a portfolio is likely to be more stable than any individual ETF, making it more likely for John to hit his monthly rent income on a consistent basis. In this video, we talked about 6 high-dividend sector ETFs that'll pay your rent, but perhaps you'd like to follow investing guru Warren Buffett and dividend stocks. For this, watch our video on Warren Buffett, 6 dividend stocks to buy and hold forever, where we show you long-term stocks that can pay over $100,000 per month in dividends.